Hello, I'm a 21-year-old investor looking to compound my wealth in the stock market. Thank you so much for 4,000 subscribers. David Tepper is more of a swing trader. He does catalyst-based investments and he's been really right about his China bet in the recent quarters. He owns around 15% of his entire portfolio in Alibaba, for example. He owns another 4% in QEP, which is a CSI ETF. For David Tepper, he does something similar to Michael Burry, just that he does it to a greater level of success. And in this quarter, he actually trimmed out of his Alibaba position, as well as Amazon, and some Google and NRG as well. And he added into a few companies in his portfolio, including Whirlpool, Nvidia, as well as TSM. For Whirlpool, I think it's an interest rate bet. For Nvidia as well as TSM, I think he's betting on the fact that your capex is going to increase for all the different hyperscalers as well as your Mac 7 companies. For example, Google as well as Meta, they've pledged that they're increasing their capex in the coming years. Meta, for example, Mark Zuckerberg has said that they'll be spending $600 billion on capex in the coming years. So Google have also said that they are planning to increase their capex in the coming years, and all this capex money will eventually have to flow to Nvidia as well as TSMC. And that's why he's added into these positions in the coming earnings report. The next super investor that I'll be covering is actually Chuck Akre. Chuck Akre is a super investor that is more geared towards quality compounding machines. He believes in investing in high quality compounding machines, but he has since retired, so he has passed the baton on to his lieutenants. And what his lieutenants have done in the recent quarters, in the past few years, is they've been selling out of his high quality positions. Almost in every single quarter, you've seen them trim MasterCard, Visa, Moody's. These three companies were companies that were instrumental in terms of Chuck Akre's returns over the past 10 years. So I'm a bit confused by that one. As for the companies that they added into this quarter, they added into FICO as well as Copart. FICO is a company that I feel is still underestimated by the markets today. They had their earnings just a few weeks ago, and the management actually gave out guidance that was quite weak in my opinion. It doesn't factor in the fact that mortgage increases will come in next year. Management also said in their earnings call that they were guiding on more of the conservative end because they didn't incorporate any expectation in terms of mortgage increases. For FICO, I think it's a company that is high quality, and that's why they actually added a lot of FICO in just the recent quarter. This one I agree with. The other position that they added into was Copart. Copart, they actually added around 250%. They basically tripled their position. So for Copart, it's a quality compounding machine as well. It's a company that has grown revenue at 15% over the past 10 years, and it is selling now because the markets are chasing all your different AI companies. Quality compounding machines like Copart are seeing rotation out of them into all your different other AI companies. Of course, I think Copart is finally offering decent value today at around $40 a share. For Copart, of course, you have the headwind of your EVs coming in to reduce the total loss frequency, but I think this is still a reality that is far-fetched. If you were to do the math, if your entire car fleet were to be replaced by EVs, it will take around 20 years from now for that reality to come. And besides that, your Trump administration have also been pushing people out of clean energy cars into your normal usage cars, into more traditional energy sources like nuclear, like gas, and so on. I don't see the reality of EVs coming in hurting Copart anytime soon. But for this company, bear in mind that there's a headwind that was actually signaled to us in the last earnings quarter. Their inventories days outstanding was actually up last quarter, meaning that inventories were down. It's a leading indicator for revenues in the coming quarters. Management has said that in the last few earnings call. In this earnings call, they actually said that it is nothing to worry about. I tend to lean more towards that it is a leading indicator. And for Copart, this could mean that the revenue won't grow as fast as what it has been in the last few years. But of course, you have the capex coming in as well, which could increase margins and increase their bottom line. That is one to pay attention to for Copart. Seth Klarman, he's a deep value investor, or at least he says so. He's more of a swing trader. He does swing and catalyst bet. He buys companies when sentiments are bad, and then he sells them in the next quarter. So in this quarter, what he has done is he has sold out of his Google position. He trimmed around 30% of it. He sold CRH, sold Willis Tower Watson, not too sure what this company does. Sold some Wesco as well. This was his largest buy. And Union Pacific, this is a railway company that is highly predictable. He bought some Ferguson as well as Eagle Materials. When you see companies like this popping up, like Wesco, like Ferguson for example, this is a source for investment ideas. So what you can do after looking at all these 13 apps is it gives you ideas to research all these different companies here. For example, Ferguson is a company that has been popping up in a lot of your 13 apps. So it definitely means that this company is great quality to a certain extent. As for its buys this quarter, the most notable one was Restaurant Brands International. I disagree with this one. I think restaurant companies are low mode companies that are extremely susceptible to economic problems. The first thing that people cut out when it comes to economic problems is takeaway food, is restaurant food, as well as travel. Normally, they'll have a rapid increase in terms of growth and then it comes down over time. This is what we're seeing with companies like Chipotle, Kava. That's why their stock prices have been down so much in just the recent months. For Restaurant Brands International, I think there are better quality companies in the restaurant industry out there, although I don't like this industry in general. I think Chipotle is a better buy than Restaurant Brands International, trading at similar valuations, so this is one that I'm a bit skeptical of. Next super investor that I'll be covering is Chris Hohn. The super investor that I really respect. What he has said in a recent interview is that he has two reasons to sell. Number one, he sells because of uncertainty. Secondly, he sells because of risk. And that is probably why he has sold out of his Google position this quarter. He hasn't sold it because he thinks the company will underperform in the coming years. He sold it merely because he's trying to protect his capital, he's trying to preserve value, and he is trying to adjust for risk, which I agree with. He added heavily into his Visa position. He added some Moody's and some S&P Global. But in this quarter alone, he actually added around 6% of his entire portfolio into Visa. The last time he added so heavily was actually Microsoft, I believe around 11% in Q4 of 2023. He makes large concentrated bets and he clearly thinks that Visa is a company that is providing value today. For Visa, I think the returns at this price are quite favorable. Assuming a 3.3% free cash flow yield return to shareholders, you only need around a 9 to 10% increase in terms of net income for you to get a 12 to 13% returns from this company, which is more than reasonable already, assuming no multiple contraction as well as expansion. For Visa, it's a high quality company and that's why he's added to it. Planning to increase my allocation as well. In fact, I increased it over the past few weeks. Chris Hohn is a high quality investor. His interviews are incredibly insightful as well. So go and watch it if you're interested in his investment psychology. Next super investor is John Armitage. This super investor is not as well known as the other investors, but he manages a lot of money as well. For John Armitage, he follows something similar to Chris Hohn. In fact, he's actually Chris Hohn's best friend. He says that Chris Hohn is a genius. For John Armitage, he takes a more different approach. So he owns a lot of companies. He owns around 40 companies in his entire list of portfolios, including companies outside of the US. And what he has achieved in the past 10 years are incredible returns. I believe it's around 20% over the past 10 years, which is quite a high return considering your hedge funds typically underperform. For John Armitage, he holds concentrated positions in companies like Microsoft, like Amazon. He added heavily into Visa as well as Amazon this quarter, and he added into Ferguson. This is another company that has showed up previously, and Boston Scientific. I think John Armitage as well as Chris Hohn are two investors that create the perfect example. So besides that, he sold out of some of his positions, including IBKR as well as Meta, as well as Flutter Entertainment. This is a company that's quite interesting. It's a company that has appeared many times in 13S. I believe the company does something similar to what Evolution Gaming does, but it is legalized gambling. And he added into some MasterCard also, which I think is decent value today. Overall, I think this portfolio is a high quality one, and it is clearly the reason why he has achieved outsized returns over the past few years, and I believe he will continue doing so. Similar to John Armitage, he owns Flutter Entertainment. He owns Alcon. He owns Microsoft, Visa, Intuit. He sold out of 1/3 of his GE position and he allocated the capital to Amazon. He sold some Moody's. But of course, Amazon, a lot of Amazon's story is dependent on AWS growth. For AWS, they're not using NVIDIA chips. They're actually creating their own chips. They're using their own TPUs without incorporating NVIDIA's chips. That is why they're seeing a lot of their customers being taken away to Azure as well as GCP. So for Amazon, I'm not too sure how to model that AWS growth portion, but just based off that retail portion, I think the company is around fair value at $200 to $210 and $220 a share, which was the price that they added in over here. So Polen Capital has been selling out of a lot of their positions. So they sold Oracle. Oracle is still their highest holding position here. Sold out of Microsoft, Amazon, Shopify. and they allocated all this capital into AVGO, which is Broadcom, as well as Nvidia. It's doing something similar to what David Tepper has done, which is to buy the AI winners and place a bet on capex growth over the next few years. Completely understand this, but I have my bets as well in ASML. Next super investor, AltaRocks Partners. This is a less well-known investor, but the holdings in here are incredibly concentrated and high quality also. So they own Amazon, Microsoft, and TransDigm. Just the top 3 positions alone constitute around 77% of their entire portfolio. This is incredible concentration. They own Moody's, MasterCard, as well as Visa. So this entire portfolio is basically a 3-stock portfolio: Amazon, Microsoft, as well as TransDigm. So they added into Amazon. So similar to what the other super investors have done, they've all added into Amazon. I think Amazon was a company that was decently priced, although it wasn't as cheap as what Google was at the start of this year. I think it's a decent idea, and he's trimmed out some of his positions also. He trimmed out of his Google position heavily, and he allocated all that capital into Amazon. So for this portfolio, I think it's a high quality one. It's a portfolio that I look out for whenever 13Fs come out because of the sheer concentration. So he does similar to what Warren Buffett does, which is to buy your 5 best ideas. And this is a perfect example of a portfolio manager that is doing it in the current environment. So Terry Smith has been underperforming the markets over the past 5 years. He's made a lot of wrong decisions in the recent times also. So in this quarter, they sold out of a decent amount of their different positions here. He trimmed half his position in Microsoft. This is one that I disagree with. I think Microsoft is a company that is almost unbreakable. It's a company that is irreplaceable in enterprises. And I think selling out of half of his position here is a risk that he's taking. So he bought other positions as well, including Visa, Waters, and he sold out of his other winners, including Meta, Marriott, as well as Philip Morris. For Terry Smith, he's been on the wrong side of his trades in the recent years. His assets under management is still incredibly high, around $19 billion, but I think his ads in the recent months and recent quarters haven't been the greatest. So I think these two sells are more related to redemptions because he didn't add as much. And in the recent quarters, and he's been cutting his winners over the last few quarters or so. So for Terry Smith, I think his investment philosophy is incredible. He follows an ROCE approach. So he buys companies with high ROCE, high margin, high growth, and that is why he has achieved incredible returns over the past 10 years. Of course, in the recent 5 years, he has underperformed, but soon enough, I think with his investment philosophy, he will get back on track. Last super investor that I'll be covering is Mohnish Pabrai. So Mohnish Pabrai, he owns only around 5 positions here, but he actually holds other positions that are outside of his US portfolio. So a lot of his positions include companies in Turkey, in India, and so on. But I'll be covering his US portfolio over here today. So he has concentrated bets into 2 companies that is in the coal industry, Warren Coal as well as Alpha Metallurgical Resources. So I think his trade over here is to bet on the reversion to the mean of your coal prices. I actually own Warren Coal, and he was the guy that actually gave us inspiration to look into this company. I think Warren Coal is a quality business, and that's why I own it in my portfolio. Besides that, he bought another company which is Rig. I think they sell oil rigs, and he trimmed some of his Valaris as well as his Noble position. I think in this quarter, he also sold out of another company which is AutoNation. It's a car dealership company. Not too sure why he has trimmed out of his position, because he was mentioning that these stocks are undervalued. He goes for catalyst-based investments, so he'll have around 10 years of underperformance, and then he'll have 1 year whereby his portfolio triples or doubles, and this was what has made him millions in his investment journey. So in fact, over the past 5 years, I think he has underperformed the S&P 500. He has continually said that the S&P 500 is overvalued, and that's why he is underperforming it. But I think this is an investment philosophy that is not really replicable. He doesn't really do what he preaches. So he preaches buying high quality companies, but he buys companies that are more catalyst based. So for the ordinary retail investor like myself, I don't think this is replicable. I think what Chris Hohn, John Armitage, Dev Kantasarya does is a lot more replicable. It's a lot more possible as compared to what Mohnish Pabrai over here does. I hope you guys have found this video useful, and feel free to leave any comments. Invest safe.